Nisreen, I suggested a couple that is between 30 and 35 that does not have children, that is both earning. How would you set the parameters for constructing a portfolio, and give us a model portfolio as well?
Sure. So, here, Alex, we can assume that, possibly their tenure is higher because they are the 30 to 35 age group. So therefore, their equity allocation would automatically be higher. They would possibly have a fewer, lesser current liabilities. So there's more room for growing of wealth. We need to have flexibility, but there's obviously, no requirement right now for, say, down payment. So their future goals would be like wealth creation, travel plans, etc. Early retirement, house, maybe, much later on. But currently we would plan on, say, the medium-term goals, which could be wealth creation and travel and early retirement. And emergency funds, because, such a couple also would tend to take sabbaticals, as mentioned earlier, take longer vacations, take work also on project base where, they work for 6 months and then they're kind of not working the last 6 months. So a lot of couples have started this kind of, job structure also. So here what I would recommend is, say, a 70%, 100%, growth allocation towards equities, which could be possibly invested in, if you need the names of the funds, we could have, like, say, FlexiCap funds, we could have Parag Parikh FlexiCap or HDFC FlexiCap for about 20% of the fund allocation. A large and mid-cap funds for 25% allocation, which could be Mirae Asset, Emerging Blue Chip, or Canada Rubico large and mid-cap. These are the kind of funds that would be part of the 70%. So 20% towards FlexiCap, say perhaps 25% towards a large and mid-cap strategy, 15% towards a mid-cap strategy like Kotak HDFC mid-cap opportunities would be a good fund. And, we could also go sectoral or thematic 10%, where we would recommend, say, ICICI Innovation or SBI Consumption Fund. This would be like a tactical allocation. So your mid-caps is focusing on higher growth and possibly will give you higher volatility. Your thematic and sectoral funds is for your tactical allocation. 10% could be, either ICICI or HDFC Balanced Advantage Fund. And also, say, a liquid fund. It could be ICICI or Nippon Liquid Fund. And a shorter term or duration fund to about 5%, which is, your Kotak Savings Fund or your SBI Arbitrage Fund. So this 5% is basically for your emergency funds or your short-term liquidity. And, you can also go 5% towards, say, a US or a global fund. So that possible suggestions are Motilal Oswal NASDAQ 100 fund of funds or a PGIM Global Equity Fund. So this is for your currency hedge. So, just to, as a synopsis, 70% towards long-term capital growth, which could be equity funds, where I've already mentioned it's a mix of FlexiCap, large and mid caps. 10% towards hybrid funds. This is just to smoothen the ride and, to ease the volatility. 15%, which is for your, emergency funding, which is long-term and short-term goals. Short-term and liquid goals, emergency funding 15%. And 5% is international equity, just for your global diversification and currency hedge. So that's your entire 100% model portfolio.
Okay, just to follow up on that, I notice in the international allocation, you've done a Motilal Oswal NASDAQ 100 FOF, which is a fund of fund and not the ETF. I just want to draw attention here that ETFs, particularly those of Indian mutual funds that allow you to invest globally, like the Hang Seng Bees or even the NASDAQ 100, they do trade at a premium on the Indian exchanges. And so therefore, I'm asking, is the fund of fund route at this juncture better? Is that why you suggested it, Nisreen?
So, both the options are available to you. The exchange-traded funds, you would possibly go to any of your, trade on your own through any of your apps, etc. And if you're taking a consolidated view, then the funds will gain importance because then, your entire investment is viewable on one format, and also you're possibly your planner or distributor is also a single person. So for ease of convenience, a fund of funds would, was possibly recommended. Then you deal with one person for across the board. But if you also have a stock portfolio and you're also trading on your own, then yes, you can go for the ETFs also, which would make it convenient for you. So both the options are available for the investor.
But do bear in mind, of course, that those ETFs are trading at a premium to the NAV because of the kind of demand-supply gap that you're seeing in international funds that are currently available in India.